Thanks for tuning in to Talking Point. I'm your host, Niraj Shah. The case for a chat today, particularly in a day like this, which is following a week of some fairly strong regulatory action, we talk about two or three things. One, whether earnings or a market correction will moderate valuations, if at all. Two, whether the RBI action will keep NBFCs under the heat. So that's the second part of the conversation. And third, what we saw the whole of last week, which is PSUs came under pressure, except for PSU banks, everything else came under pressure. And whether this is the beginning of the peak of the PSU rally. And somebody who called some of these trends out really well, way early, is Nirav Sheth, CEO of Institutional Equities at Emkay Global Financial Services. I remember, viewers, Nirav's comment to me sometime in 2019 or 20, wherein midway through the interview, he said, Niraj, you're looking for the big headline on your interview? The headline is that PSU banks will outperform private banks. This was somewhere in 2020. And the historical performance is, well, vindication of his belief out there. Nirav, great having you. Thanks for taking the time out.
Thank you, Nirav.
So, Nirav, let me start off with whether you are skeptical of the valuations, as a lot of people on the street are, or do you believe that the strong Indian growth, policy continuity, etc., 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 will keep valuations higher?
So, do you want to buy good stories cheaply? You want to buy that. Do you get that on a platter? Usually doesn't happen. All of us want corrections, but when corrections come, they will come with a specific reason and a serious doubt, which means that you may not be necessarily able to pull the plug then. I mean, the markets were down 30%, the stocks were down 50-60% after pandemic. None of us had a template in terms of how things will play out, right? How many of us actually went and bought anything over there, right? So I am still of the view that we are obsessively focused about valuations, which is important and a key determinant of your long-term returns. But I think we are not giving enough emphasis to very strong economic momentum and what I would also call very strong political momentum. I have not seen 70-80 basis points upgrades in GDP in a long time. Your income tax returns are compounding at about 26-27%. Your direct taxes, indirect taxes are up by about 15-16%. The leading indicators, the PMIs, right, for services is above 60, for manufacturing close to about 55. And this is when, the entire global world seems to be sort of slowing. Just don't look at India, right? So US is making global highs. Europe has made global highs. Japan is all-time high after 1989. Right, because economic momentum globally has been better than expectations. You are at the fag end of your interest rate cycles, and yes, so I'm very constructive on the markets, and that doesn't mean that markets can tell you another 10%. They can, we don't know. But if you dig deeper, harder, there are enough ideas around in the large cap space and also in the mid and small cap space. And I reiterate that for the next several years, I expect the broader markets to outperform the narrow markets, because that, I would call it democratization of the earnings. Large part of the economic, companies are getting big benefits out of what is happening in the country.
In fact, some of the themes, Nirav, that have come up in the last 2-3 months, or 2-3 years, excuse me, are all themes which are not present by necessity in market cap in the top 100 companies. So I would love to understand, because in the last 2 years, your conferences have had a slew of these mid-cap companies which are promising earnings growth, which are very promising stories. Maybe valuations might be expensive currently, but look very attractive from a growth perspective the next few years. What is it that stands as first amongst equals, or as firsts amongst equals within this mid-cap universe for you in terms of earnings growth or promise?
So I think you have, big surprises in the capital goods sector, right? So let's say, for example, and I struggle with this, right? So, for example, there is a very high degree of visibility when you look at the investments that will happen in power. And I'm talking about thermal power, to renewables and stuff like that. None of the capacities have come up in the last 10, 15 years, right? So the transformer companies, in the boiler companies, the EPC companies, there's a big change over there. Likewise, I'm struggling to figure out, what is happening in data centers, right? 1 megawatt will cost you about 40 crores, and we are talking of some serious amount of capacity that is coming up. We are talking about investment that is happening in the smart meters, and 250 million smart meters over the next 3 years. Each one of you will cost about 10,000 bucks. So there are big numbers we are talking about. Uh, the interesting thing is, uh, when you usually talked about capital goods 5, 10 years back, it was largely old economy, right? So a lot of the infrastructure is going in, including in digital infrastructure, in data centers, in stuff like that, right? So e-commerce, electrification, and therefore it's important that you try and analyze, how this ecosystem is going to spread. Think about semiconductors. You're not talking about small numbers. You're talking about almost about 1.4 trillion now, which has been officially converted to three guys, going to set up capacities in the Fed. Uh, so I see this space to be very, very interesting going forward. And a lot of the companies I believe will get listed, right? So today you got L&T, you got BHEL, and then there is a big tail, and then you do your work and try and figure out where you want to be. But I'm a great believer of manufacturing, come back in India, and I believe that capital goods will have a role over the next several years.
Okay. Um, Nirav, so the valuations are you reckon here the story is the same, that earnings growth will make up for valuations? Because when I look at the MNC cap good companies, while they were priced to perfection, ABB, for example, was priced to perfection at 4,200, but then come the results, then come the commentary, and the market suddenly realizes that, hey, a stock at 80 PE or whatever the PE may have been then is also okay because of the earnings growth and the commentary, and the stock bumps up 15, 20%. So it's not that the market didn't know it was expensive, and yet good results are making up for it even in one quarter. So how are you playing this? Are you buying the cheaper second tier non-MNC cap goods, or are you comfortable even with the MNC cap good companies which have got the technology advantage?
See, it's a very good question. And, this is a conversation that I have with a lot of my clients. It's not very easy to see 10 years out, right? So, while I'm very confident about what's going to happen in terms of the capex recovery and stuff like that, I think the way to go forward is by having a very diversified portfolio, right? So I would create a portfolio which will have probably an equal weight in Siemens, an equal weight in ABB, maybe even an underweight. But I'll create a long tail, right? Which is like owning a lot many stocks. And which is on coming back to my point that I made earlier. I would expect BSE 500 to outperform Nifty 200, Nifty 200 to outperform Nifty 50 over the next several years, right? Because I see earnings moving away. And I'm talking about the growth, not necessarily about absolute. The growth in the larger, broader markets will be significantly higher than in the top 50 companies. And eventually, the market prices are driven by earnings growth rate. So, to answer your question, I would have a diversified portfolio. So, for example, if you just look at the largest small cap mutual fund in the country, the suspect is Nippon Small Cap. They would have close to about 250 to 60 odd companies. And I think that is the way forward. I think you can today, given the diversification that the economy offers, you can actually create a portfolio of 300 companies and do very well.
Okay. Fair point. Nirav, the other thing is the kind of changes that are coming on the regulatory side for some spaces, and I'm kind of keeping it narrow to power for now, because last week this whole conversation around the change in the bidding process for renewable energy or wind energy brought about a serious correction in some of those names as well, related names. And the companies are coming out and saying, hey, look at the targets, look at the things that have already been given out, and we are fine for the next 3, 4, 5 years, baat ki baad mein dekhenge. I'm trying to understand, when you look at such things, how do you react to them?
So I think now, for people like us who are great believers in, free market capitalism, laissez-faire approach, and now with the benefit of hindsight, we also appreciate that there are market failures that tend to happen, right? So you can't leave everything to markets. To that extent, I have become far more accommodative about regulatory, interventions, if you want to call that. We've seen that with RBI. We tend to again focus very much on the negative impact, while we completely forget that they're systemically taking risks away, right? So, and they've done a wonderful job. For example, the fact that SEBI's intervention in terms of the leverage that you have against the small cap stocks. Now just think of it. Every time you've got corrections in the broader market, your mid caps tend to fairly hold on to their own. So there is no collateral damage, because earlier you used to leverage the small cap stocks and buy the futures and stuff like that, right? So over a period of time, you realize that there is an element to it, right? So, and in some of the cases, you may give away some basis points of growth. For example, if RBI is very conscious about the growth in unsecured loans and you're raising the risk weights, maybe you'll grow a bit slower, but you will grow longer as well, right? So you'll not have big peaks and big troughs. That incidentally should improve your valuations as well.
Okay, let's get in my colleague Anushi, who brings in a quick perspective about a note wherein they've gone out and downgraded, or maybe speaking about India financials, have downgraded SBI as well. I think that's Bernstein. Anushi, a quick word on what Bernstein has to say.
Absolutely, Niraj. So Bernstein has downgraded SBI to market perform rating, emphasizing the need to it's time that we switch back to private banks instead of PSUs now. So a couple of reasons over here. They are seeing a less promising trajectory over here for PSBs on account of the weaker deposit growth again over here and lower liquidity buffers. Another is the aggressive pricing that has been noticed by in the loans and deposits, which will eventually lead to a muted earnings growth going forward. Also, the third and a critical point over here is the valuation gap, which has kind of narrowed significantly if you have to look at PSB and private banks. So these are a couple of reasons they have cited on why they have downgraded SBI and overall and switched to private banks focus more.
Anushi, thanks. That was really quick but effective, because you give us a sense of what they are trying to say. Now, Nirav, I'd love to come to you on two parts here. First, today, some of your peer sets have come out. Somebody's downgraded PSU Bank. Somebody said that, oh, is the PSU rally overdone, etc. I'm trying to understand from you. Are you of the same belief that the run-up is too fast, too soon? Because last week, too, a lot of PSU stocks came under pressure.
So I am very, very constructive on PSU in general. And now let's look at it, right? So, have they rallied? Of course, they have rallied. The question is that why they have rallied. So now let's look at SBI, for example. SBI, if you look at consensus estimates, right, it is likely to grow at about 15% CAGR over the next 2 years. I'm talking about earnings. Their average ROE over the next 2 years will be 17%. Now, this earnings growth rate is higher than ICICI, it is higher than SDFC, and I think it's higher than Kotak, right? And ROEs are similar. So the fact of the matter is that when I look at the next 2 years, and if I just forget that it's a PSU balance sheet, and if I just look at the color of the dollar, which is always green, then SBI seems to be outperforming. I think Axis is slightly ahead of SBI Bank. So the markets have rewarded a big evolution in ROE, and the fact that your earnings CAGR is similar to other larger peers, and you are getting it at a discount. Number one. So I mean, nothing of this has happened in isolation. You can make a case that PSUs will grow slower than private sector banks, and therefore I can downgrade. And it's a call that you can take. I am not of that belief, number one. Secondly, when you look at the consensus earnings right now, people are looking at credit growth rate, which is CDET, right? We're looking at about almost 14-15% growth rate in earnings. If you look at the last 10 years, India's credit growth rate has been in line with nominal GDP growth rate, and therefore your credit to GDP ratio has been essentially flat. which is disaster for developing country like India, right? So I believe that you are going to get serious surprises. And I reiterate again, you are going to get serious surprises when the credit growth comes back, especially from capex recovery, which I just alluded to a while back, right? And the guys who are going to write a 10,000 crore check, for example, when you're talking about 1.5 billion of investment happening in semiconductor, the guys who are going to write a check for 10,000 crores, 20,000 crores will largely be PSU banks, right? And I would expect private sector banks to be slightly more cautious about getting into project lending. We have not even seen that infrastructure lending. We are not even seeing the real participation that is going to happen. So if my assumption is right, then you are likely to see earnings upgrade happening in PSU banks. Now let's look at energy sector, not only PSU banks, right? What had happened in OMC companies? You got earnings upgrade by 100% in fiscal 24. And in the first half, the stock price was going down because analysts were refusing to believe that OMCs will not cut their prices pre-election. Suddenly, there was a big realization, and the stocks rallied, and they rallied furiously. But there was a catch-up that had to happen. You cannot expect this company traded 2 or 3 P, at the end of the day. Likewise, I'm just for reflection. Even today, OMC trades at 10% free cash flow yield. Why would you not buy that, even if you think it's a growth? So I would keep my eye and focus on earnings, ROE, and the valuation context. I see no reason to be outside the PSU. And I think they are governed far, far better than what they were a decade back. So you have to make some adjustment for this as well.
Got it. Um, the other thing is this whole regulatory action that is turning up the heat on select pockets of the market. Recently, I mean, one financial services institution, the other an NBFC, before that Paytm. There's lots happening, right? And I mean, is this something that might make people a bit cautious on the valuations in that bucket, or are these isolated cases, you think?
I would like to believe that it will be isolated cases. As a matter of fact, I believe that and this is what you just got in public domain, right? So there were some lapses on operational side, and we're seeing some interviews happening today that, those are being corrected. In all the cases, RBI has been extremely clear that, we'll come back, we'll do a re-audit, and if things are in order, it will be business as usual. So in a way, you are trying to send across a message that rules are rules which need to be adhered to. And in a way, I think it's good. So, it could lead to people may overanalyze the situation and stuff like that. I just think that, my sense is that our regulators in India have become far, far more agile. And I also believe that a part of this could also be driven by the fact that you are into pre-election, mood right now, and you want to be very, very clear and agile about the fact that you don't want to get any risks emanating for anyone that can create some sort of political chaos. And therefore, you'll probably try and err on the side of the caution. I have not seen anything that would force me to have a look at, structural impediments to growth. Nothing on those lines so far.
Okay. Nirav, my final question. Where is it? I mean, on PSU banks or PSUs on select other pockets, you are way ahead of street when the street did not factor in. Where is it that you are completely anti-consensus with the street?
So I would like to believe the first thing, and I mean this is more of a macro call. I'm not a bottom expert, so I would stay away from metals. That is something that I don't like. China is deflating. 9-10 months of deflation. They just had a positive print, marginal positive print. Excess capital is being set up over there for the world, and world is not ready to receive that. So a lot of chaos. So I don't want to look at commodities, and that actually makes me very bullish on India, right? Because we are generally a net importer of commodities and therefore inflation. Second thing is consumers. So a lot of these companies started trading at 60, 70, 80 times without any great improvement in growth in free cash flows, right? So while their net margins have doubled in the last 10 years, it has not led to a corresponding increase in the growth in free cash flows. And I think the competition is hotting up. So given to me. Let's say if I'm running an extreme portfolio without any respect for benchmarks, I'll be zero weight on all the consumer companies. I'll be zero weight on the commodities. I want to play the India story over the next several years.
Got it. Okay. Point well noted. Nirav Sheth, thanks as always for taking the time out and giving us your thoughts. Really appreciate your time.
Thank you. Thank you for having me, Niraj.
The pleasure is always ours. And viewers, thanks for tuning into this edition of The Talking Point.